So clearly, we have continued to see a little bit of pessimism within the markets. We see that the news with regards to industrial profits contracting towards the tune of around 20% year on year suggests that the recovery that we've witnessed since the beginning of the year will take some time to materialize. After all, a lot of the strength that we've seen in terms of data has really been concentrated on the consumer side, and it hasn't really trickled down with regards to industrial production, manufacturing, or other parts of the economy. So the way that we see it is that in terms of seeing the data on the profit side, we probably have to wait a couple of quarters before that starts showing in terms of the data.
So in terms of your investments into China, what do you want to own, and to what extent is this just a play on anticipated further stimulus from the central bank?
Well, there certainly is going to have to be a little bit of stimulus. The way that we see things is that China will have to deploy a little bit more fiscal stimulus, a little bit more targeted easing as well. At the end of the day, unemployment, especially in the youth part of the population, is too elevated, and they will have to bring that down in order to achieve their growth target going forward. In terms of what we own and what we expect is going to outperform, well, clearly, we do see a lot of the strength, which is focused in terms of the services part of the economy and the consumer. It's not only that, of course. We know that China has a goal with regards to upgrading their investments on the technological side. They're going to have to secure resilience on their supply chains, and they're going to have to revamp their attitude with regards to that. So at the end of the day, we saw a rally in the first couple of months of the reopening. There had to be a re-rating of markets that were relatively depressed. Since then, we haven't seen Chinese markets going anywhere. But at the end of the day, the second leg of the rally, in our opinion, is going to be attributed first due to some of the stimulus that we expect. But at the end of the day, essentially, we think that there is going to have to be that employment drive. There will have to be that confidence boost that will have to materialize in order to encourage the Chinese consumer to go out and spend more. So right now, the pessimism is there. We think that the market does stand to be surprised in the coming months as the economic data starts rebounding.
Georgios, one of the big trades on global markets has been the generative AI trade. When it comes to China, there are three big stocks that have been pivoting towards AI, effectively the likes of Alibaba, Baidu, Tencent. But these names all have attracted the attention of regulators in China for their size already. So how do we think about playing the AI trade in China? Is it not possible at this stage? Are there caveats around it? How are you thinking about it?
Yes, I mean, clearly there has been a big hype right now, and obviously artificial intelligence, we see that the tech story broadly is gaining more and more attention, especially on the developed market side as well, with the earnings potential, more and more companies citing this on their earnings reports, and we do expect that to play out. In terms of China, we have seen that Hong Kong-listed stocks have been trending lower. Obviously, there's a lot of reasons. Part of that has been the concern of the market that the first quarter momentum may have lost a little bit of steam on a sequential basis. Obviously, the geopolitical backdrop is still one which garners scrutiny from the international community, and that has obviously been a setback with regards to the performance of that space. At the same time, we think that the regulatory intervention that was witnessed over the last couple of years is probably not going to be an obstacle in the same way that it has been in the past. If the Chinese are serious about achieving their growth targets, they will have to encourage foreign capital to come towards the market. They will have to deploy a more predictable strategy with regards to deploying regulation. Regulation is not a bad thing. What markets want is certainty, clarity, and the avoidance of disruptions. There has been a little bit of progress if you look at the last few months, whether it is the restructuring that we have seen in Alibaba, whether it is the stakes that Chinese government-owned entities have snapped up with regards to gaining a share of individual companies, perhaps managing their control by being on the board, by being involved in some of the decisions, rather than penalizing these companies. Gaming approvals, for example, are also some of the indications that have demonstrated a more pragmatic approach from the local side. So ultimately, right now, a lot of clouds that have weighed on the performance, but as we move forward towards the end of the year, the macroeconomic picture should start to gain a little bit of momentum. And at the end of the day, the foreign community does not own a big exposure on China. So I think that the incremental tilt towards adding positions will also come when the international community gains a little bit more confidence on the macro story.